Financial leverage simply means the presence of debt in the capital structure of a firm. In other words, we can also call it existence of fixed charge bearing capital, which may include preference share capital along with debentures, term loans, etc. The objective of introducing leverage to the capital is to achieve maximization of wealth of the shareholders. Financial leverage deals with the profit magnification in general. It is also well known as gearing or trading on equity. The concept of financial leverage is not just relevant to business, but it is equally true for individuals as well. Debt is an integral part of financial planning of anybody, whether it is an individual, firm, or a company. We will try to understand it from the business point of view. In a business, a debt is acquired not only on the grounds of need for capital, but it is also taken to enlarge the profits accruing to the shareholders. Introduction of debt in the capital structure will not have an impact on the sales, operating profits, etc., but it will increase the share of the equity shareholders, the ROE, which is return on equity percentage also. Financial leverage indicates the reliability of a business on its debts in order to operate. Knowing about the method and technique of calculating financial leverage, it can help you determine a business's financial solvency and its dependency upon its borrowings. The key steps involved in calculations of financial leverage are: number 1, compute the total debt owed by the company. This counts both short-term as well as long-term debt, also including commodities like mortgages and money due for services provided. Estimate the total equity held by shareholders in the company. This requires multiplying the number of outstanding shares by the stock price. The total amount thus obtained represents the shareholder equity. Number 2, now divide the total debt by total equity. The quotient thus obtained represents the financial leverage ratio. If financial leverage ratio of a company is higher than 2:1, it indicates financial weakness. If the company is leveraged highly, it is considered to be near bankruptcy. Also, it might not be able to secure new capital if it is incapable of meeting its current obligations. Too much leverage can be bad, but there is no hard and fast rule as to how much is too much. No matter what its use, leverage can be a powerful tool when used responsibly. Savvy investors and companies use leverage to expand, hedge, and speculate, but overly aggressive can easily get in over their heads by losing money or going into bankruptcy. For investors considering companies with debt, one of the most popular evaluations of a company's leverage is the debt to equity ratio, that is debt upon equity. The interest coverage ratio, also known as times interest earned, is also a measure of how well a company can meet its interest payment obligations. In general, these ratios suggest whether a company is too safe and is neglecting opportunities to magnify earnings through leverage or is over leveraged and at serious risk of default or bankruptcy.
After studying this module, we shall be able to understand the concept of financial leverage, know the various measures of financial leverage, comprehend the meaning, computation, and interpretation of degree of financial leverage, learn the meaning of financial risk and its relation with the financial leverage, explain the application of financial leverage, discuss the significance of financial leverage. We start this module with the meaning of financial leverage. The usage of fixed cost bearing securities, that is, preference shares and debt, together with the owner's equity in the capital structure is known as financial leverage or capital gearing. In the words of Guthman, financial leverage is the ability of the firm to use fixed financial charges to magnify the effect of changes in EBIT on the firm's EPS. Various measures of the financial leverage are debt ratio, debt equity ratio, interest coverage ratio, ICR. We will start with the debt ratio. It is the ratio of total debt to total assets, expressed in the percentage and can be interpreted as the proportion of the company's asset that are financed by the debt. Debt ratio is equal to the total debt upon total assets. The higher this ratio, the more leverage is the company, and the greater is the risk of default on the payment of the fixed financial obligations. A debt ratio of greater than 1 indicates that a company has more debt than the assets. Debt equity ratio. It is a financial ratio indicating the relative proportion of the shareholders' equity and debt used to finance the firm's assets. Debt to equity ratio is equal to debt upon shareholder or owner's equity. It can also be measured in terms of book values or market values. A high debt equity ratio generally means that a company has been aggressive in financing its growth with debt, or the firm has high financial leverage, or it is highly geared. A debt equity ratio of more than 1 indicates that the company has more debt than the equity. A debt equity ratio of less than 1 indicates that a company has more equity than the debt. Suppose Sakshi Limited has owner's equity of rupees 600 million and debt of rupees 300 million. We can find out the debt to equity ratio by substituting the given values in the formula such that the ratio comes out to be 300 upon 600 is equal to 0.50. Interest coverage ratio ICR. ICR is equal to EBIT upon interest expense. The lower the ratio, the more the company is burdened by the debt expense. When a company's interest coverage ratio is 1.5 or lower, its ability to meet interest expenses may be questionable. An ICR below 1 indicates the company is not generating sufficient revenues to satisfy interest expenses, as EBIT will be less than interest expense. For all values of ICR more than 1, EBIT will be greater than interest expense. Let us now proceed to understand the meaning and computation of degree of financial leverage, DFL. DFL is the ratio that measures the sensitivity of the firm's earning per share to the fluctuations in its operating income EBIT as a result of changes in its capital structure. DFL is equal to percentage change in EPS upon percentage change in EBIT. It can also be worked out using formula as shown here.
Let us study with the help of an illustration. Universal One Private Limited has the following capital structure. Source of funds are equity share capital, rupees 10 each, 10% preference share capital, rupees 100 each, and 10% debentures, rupees 100 each, of rupees 50,000, 1 lakh, and rupees 1 lakh respectively. Calculate degrees of financial leverage if earnings before interest and tax is case 1 rupees 1 lakh, case 2 rupees 80,000, case 3 rupee 1 20,000. Assume 50% tax rate. Solution. Here preference dividend is equal to 10% of rupee 1, that is rupees 10,000. Interest on debentures is 10% of rupees 1 lakh, that is 10,000. Tax rate T is 50%, that is 0.50. Case 1 can be solved as follows. EBIT is 1 lakh. DFL is equal to EBIT divided by bracket start EBIT minus interest expenses bracket closed multiplied by 1 minus T whole minus preference dividend. Therefore, by substituting the values or figures given above in the illustration, we will get DFL equal to 2.86. Hence, degree of financial leverage DFL is 2.86 when EBIT is 1 lakh. Case 2, when EBIT is rupees 80,000. So, by substituting the figures in the formula, we get DFL equal to 3.20. Hence, degree of financial leverage DFL is 3.20 when EBIT is 80,000. Case 3, when EBIT is equal to rupees 1, that is 20,000. So, by substituting the figures in the formula, we get DFL equal to 2.67. Hence, degree of financial leverage DFL is 2.67 when EBIT is 1,20,000.
Interpretation of DFL. Higher the fixed financial cost, greater would be DFL. Higher the DFL, the more volatile will be the EPS. Higher the DFL, the more is the financial risk. Also, if DFL is equal to K, an X% increase or decrease in EBIT will produce a K times X percentage increase or decrease in EPS. Let us consider an example to understand the calculation of DFL. For Advaita Limited, whose EBIT has increased from rupees 100 million to rupees 150 million and EPS has increased from rupees 4 per share to rupees 7 per share. By substituting these values in the formula discussed earlier, we can get the value of DFL as 1.50 as can be seen from the calculation shown here. Let us now discuss the meaning of financial risk and its relation with the financial leverage. Financial risk is the possibility that a firm will be unable to meet its financial obligation like payment of interest on debt. High degree of financial leverage increases financial risk. This is because with more use of debt, interest payments increase. As a result, earnings available to the equity shareholders decrease. Therefore, EPS is negatively affected by interest payments. Since Fixed financial obligations in the form of interest payments is high. The chance of default in making these payments increases in case the firm's EBIT falls. Application of financial leverage. Finance manager can easily ascertain whether the firm should use more financial leverage or not by comparing the cost of debt financing with the firm's average return on the investment ROI. So, there can be following three situations. First case, when ROI is more than the cost of debt. Use of debt will result in the positive net benefits to the shareholders, and so more debt should be employed. This situation is also known as favorable financial leverage or known as trading on equity. Second case, when ROI is equal to cost of debt. Use of debt will not provide any additional net benefit to the shareholders. Instead, use of more debt will only increase the financial risk. Hence, more leverage should not be used. Third case, when ROI is less than the cost of debt. Use of debt will cause net loss to the firm and earnings to the equity shareholders will decline. So, in this case, firm should not use any more debt. This situation is also known as unfavorable financial leverage. We wind up this module by discussing the significance of financial leverage. Financial leverage magnifies the increases or decrease in EPS caused due to an increases or decrease in EBIT. For firms that manage financial leverage effectively, subsequent funds are easily available at more attractive interest rate due to improvement in the firm's credit rating. Use of more debt reduces the overall or weighted average cost of capital of the firm, WACC. A reduction in WACC means that more projects will be profitable and can be selected. In this module, we have learned that the financial leverage or capital gearing is the ability of the firm to use fixed financial charges to magnify the effect of changes in EBIT on firm's EPS. Various measures of the financial leverage are debt ratio, debt equity ratio, and interest coverage ratio. Then, we have discussed the degree of financial leverage, its computation and interpretation, financial risk, its significance, and its application on financial leverage.
Let us now recapitulate what we have learned or studied so far. Financial leverage is the degree to which a company uses fixed income securities such as debt and preferred equity. The more debt financing a company uses, the higher its financial leverage is. A high degree of financial leverage means high interest payments which negatively affect the company's bottom line earnings per share. Financial risk is the risk to the stockholders that is caused by an increase in debt and preferred equities in a company's capital structure. As a company increases debt and preferred equities, interest payment increases, reducing earnings per share. As a result, risk to stockholders' return is increased. A company should keep its optimal capital structure in mind when making financing decisions to ensure any increase in debt and preferred equity increase the value of company. Financial leverage or company gearing is the ability of the firm to use fixed financial charges to magnify the effect of changes in EBIT on firm's earnings per share. The key steps involved in calculation of financial leverage are: compute the total debt owed by a company. This counts both short-term as well as long-term debt, also including commodities like mortgages and money due for services provided. Estimate the total equity held by shareholders in the company. This requires multiplying the number of outstanding shares by the stock price. The total amount thus obtained represents the shareholder equity. Divide the total debt by total equity. The quotient thus obtained represents the financial leverage ratio. Financial leverage simply means the presence of debt in the capital structure of a firm. The objective of introducing leverage to the capital is to achieve maximization of wealth of the shareholders. If the financial leverage ratio of a company is higher than 2 to 1, it indicates financial weakness. If the company is leveraged highly, it is considered to be near bankruptcy. Also, it might not be able to secure new capital if it is incapable of meeting its current obligations. Various measures of financial leverage are debt ratio, debt equity ratio, and interest coverage ratio. Degree of financial leverage, that is DFL, is a ratio that measures the sensitivity of a company's earnings per share to fluctuations in its operating income, that is EBIT, as a result of changes in its capital structure. In a business, a debt is acquired not only on the grounds of need for capital, but it is also taken to enlarge the profits accruing to the shareholders. Introduction of debt in the capital structure will not have impact on the sales, operating profits, etc., but it will increase the share of the equity shareholders, the ROE percentage, that is return on equity percentage. Degree of financial leverage, DFL, is equal to percentage change in earnings per share divided by percentage change in earnings before interest and tax, which equals delta EPS by EPS whole divided by delta EBIT by EBIT, which equals EBIT divided by bracket start, EBIT minus interest expenses, bracket close, multiplied by 1 minus T whole minus preference dividend, which equals EBIT divided by earnings or profits available to equity shareholders. The degree of financial leverage, or DFL, helps in calculating the comparative change in net income caused by a change in capital structure of the company. The ratio would help determining the fate of net income of the business. This ratio also helps in determining the sustainable financial leverage which is to be used to achieve the business goal. The higher the leverage of the company, the more risk it has, and a business should try and balance it, as leverage is similar to having a debt. This formula can be even used to compare data of many companies that can help an investor in deciding which company to invest in, based on the result of how much risk is attached with each company's capital structure. It would help an investor to strike a great deal as and when there is an economic decline. The losses of the company can be substantiated with this investment, and during the rise in the economic conditions, the volume of sales would be well compensated. The degree of financial leverage is useful for figuring out the fate of net income in the future, which is based on the changes that take place in the interest rates, taxes, operating expenses, and other financial factors. Debts added to a business would provide an interest expense to the company, which is a fixed cost, and this is when the company's business begins to turn to provide profit. It is important to balance the financial leverage according to operating costs of the company, as it would minimize the level of risks involved. Financial risk is the possibility that a firm will be unable to meet its fixed financial obligations, such as payment of interest on debt. A high degree of financial leverage increases financial risk. A finance manager should use financial leverage when return on investment is greater than cost of debt. This situation is called favorable financial leverage or trading on equity. Financial leverage magnifies changes in earnings per share due to change in earnings before interest and tax. Its prudent use improves firm credit rating, reduces weighted average cost of capital, and makes more investment alternatives profitable. Financial leverage indicates the reliability of a business on its debts in order to operate. Knowing about the method and technique of calculating financial leverage can help you determine a business's financial solvency and its dependency upon its borrowings. Too much leverage can be bad, but there is no hard and fast rule as to how much is too much. No matter what its use, leverage can be a powerful tool when used responsibly. For investors considering companies with debt, one of the most popular evaluations of a company's leverage is debt to equity ratio.